Alright guys, welcome to the second module where things are going to get very serious. So I want you to pay attention. I want you to take as many notes as possible. So we are going to not waste any time and start right off the bat that how the market manipulators manipulate the crypto markets and why these concepts work better in the crypto market rather than the stock market or the forex market. So we are going to cover smart money concepts, how you are basically going to understand where the big players are placing their orders, where they're trying to take the market next, and how they basically manipulate the market. So over here, I've got a very beautiful example for you guys. So recently I took a trade in Bitcoin. So what happened was I shorted the markets over here at this particular level. I shorted the markets over here. And as any normal trader, where the stop loss would be, where a normal trader would place the stop loss, it would be somewhere around here, or somewhere around here, right? But the thing with crypto markets is like I said, they are highly manipulative and it is very easy to blow up your account in the crypto market. And look, you can see what happened. The market went lower. The market started forming lower highs and lower lows, and then the market gave a breakout. So even if a beginner, if a person who is very serious about technicals, he would have placed his stop loss here, or even here, and all the three people were hunted with their stop loss. So first of all, why did this happen and why this needs to happen in the crypto market? Let's try to understand that. So this is something that I call the liquidity pool. So if you see this, if I make this particular trend line, if I make this particular triangle, what's going to happen? The market is going to go lower. The market is going lower in this particular triangle, and all the people that are serious about technicals, I call these people technical bookworms. So what these bookworms do, they will place the stop loss right over here or here or here, and the big players clearly know that there are the stop losses over here. Now if the big players, they are planning to take the markets lower, if they're planning to short the markets, what they need is they need a lot of short positions, correct? But to create a short position, there should be a buyer in the market. If you want to sell something, there should be someone who is willing to buy, correct? And if you want to buy something, there should be someone who's willing to sell, correct? But if you want to short the markets and if there is no one to buy, how are you going to short the markets? And that's exactly what big players do. So if they want to short the market, if they are planning to take the markets lower, what they are going to do is they are going to first hunt your stop losses. Because if you are short in the market, your stop loss is going to be a buy order, correct? And if they hit your stop losses, your buy order is going to get triggered and they will accumulate their shorts. So over here, stop loss is triggered, they accumulated shorts. Here, stop loss triggered, accumulated shorts, stop loss triggered, accumulated shorts, and then finally market continued a little bit lower, and market will probably even go lower from here. Because what's going to happen, what has happened over here, the big players, the market manipulators, they took advantage of the whole liquidity pool. Basically the retailers and the new traders, the technical bookworms, what they do, they place the stop losses somewhere around here or here, and then all of the stop losses will get hunted. The big players, they will place their shorts, and then finally they will dump the markets. So this is something that is very common. Just like here, once again, if you see, so let's just say if you shorted the markets over here, where would your stop loss be? Somewhere around here, or even somewhere around here, correct? What happened? The markets pumped, they took out all the stop losses, the buy orders triggered, they placed their shorts, and then we dumped. So this is exactly how the big players benefit from the retailers, and this is something that I call the liquidity pool hunting. What they are going to do is basically they know where your stop losses are, and that's why they are going to hunt your stop losses. They are going to build their positions that they want, and then they are going to dump the markets. So even if you look at the recent activity that happened in the crypto market, so if you see, let's just say if you wanted to short the market somewhere around here, you'll just go to the hourly time frame. So over here, let's just say you wanted to short the markets, you saw that okay, there's some resistance over here, the market took some resistance over here, okay, and the markets can go from lower from here. But what happened? They know that your stop losses are above this level. What happened? The market went lower, then it hunted the stop loss exactly, you can see exactly above that, it hunted the stop losses, they built their shorts, and the market dumped. So this is how the market manipulators take advantage of your stop losses. They build their own positions and then they dump the markets. This is something that I call the liquidity pool hunting. So this is the first thing. This is going to open your eyes and how you're supposed to basically set your stop losses. So let me just give you an example of how in my recent trade, where did I place my stop loss. So this brings us to the second concept of what an order block is. So let's try to understand what does an order block means. So order block is basically a certain big order, a big chunk of order that a big player has placed possibly. And how do we understand that? Where we can possibly see that a particular order block has been placed? So basically, if you want to identify an order block, all you have to see is from where a big chunk of momentum happened. So for example, you can see this particular fall over here, correct? So from where did this particular fall start? So if I just draw a rectangle, I can say that this particular candle, to be precise, this particular small candle over here is where the order block is. Why? Because exactly from there you can see the market started dumping. So there's definitely a very high chance that over there there was a big order placed to dump the markets, and it's pretty much simple. So what is going to be happening next in the chart? So basically, whenever the chart goes higher, so for example, let's just say the big player who placed the order over here in this particular candle, he placed an order for 100,000 shorts, basically 1 lakh shorts, and let's just say over here only 75,000 shorts executed. So what's going to happen? The price eventually, if the price comes back, it's going to take a resistance over here. Why? Because 25,000 shorts were yet to be completed. So when the price comes over here, the order block hits the order block, it will act as a resistance and the price will go down. So order block is a certain concept that works very well into the markets, and especially in the crypto markets, and order block is something that you should be knowing about. So let's dive deeper into order blocks and try to understand how you are supposed to basically identify. So the concept is very simple. First, you just have to see from where the market did a big move. So over here, let's just take this particular big move into consideration and try to understand where the order block was. So this candle, after this particular candle, the market started going higher. And remember one important thing: how are you supposed to draw an order block? So the candle that has formed before the whole big move, you are going to consider the whole candle as the particular order block. So if I just draw a rectangle around it and I extend it, this was my order block over here. And then you can see what happened. The market pumped, the market came down, the market dumped, and exactly from that order block, the market went higher. So this is a very important concept and definitely works really well into the crypto markets. Let's just try to understand some more of them. So if I talk about a certain fall, or let's just take a particular rise over here. So from here, the market started pumping. If I consider this particular candle as my order block, the red candles to be specific, you can see this was a really good order block. The market came down, it respected the order block and then went higher. And trust me, this works so well even on the 15-minute time frame. Even on the 15-minute time frame, this works very well. But to be precise, this works super well on the 4-hour time frame, 1-hour time frame, and the 1-day time frame. Prefer higher time frames when using the order block concept, because obviously usually what happens is the big players, they are obviously trying to place orders over a certain period of time. They are not just going to dump all their money into the markets. So even if you see over here, if you consider this particular pump and I draw this an order block over here, so you can see the market came over here and it halted over here. So basically, first of all, this move was just a pump to trap the traders. So obviously the orders were not that big, and hence you can see the market came, still there was some sort of halt, but then the market went lower because first this move in the first place was just a trap of liquidity pool hunting. So let's try to find out some more order block concepts and show you guys some good examples of how an order block, how you're supposed to identify an order block. So over here, this we went over this. Let's try to find out a big move, and then we are going to understand the order block, and we'll basically try to find out an order block. All right, so if we just talk about this small move on the downside, if we draw an order block on this particular green candle, you can see if I extend it, the market respected that very well and then did some downside movement. But like I said, this works really well on the higher time frame. So I always prefer working with the order block concept on the higher time frames, because like I said, obviously the orders are going to be placed on the higher time frames on a bigger levels and not just on the smaller time frames. The big players do not care about what's happening in the next 15 to 20 minutes. So obviously follow these concepts only and only on the higher time frames. And let's try to place this particular concept on the weekly time frame as well. So even if we place this order block concept on the weekly time frame, you can see we had a good pump over here. So the order block candle is going to be this particular candle, and I'm going to extend it like that, and you can see the market is considering this particular zone. So obviously, unless and until this zone is not broken, there is definitely going to be buying pressure, because this is a huge order block on the weekly time frame. So let's try to consider some more. Okay, so over here we've had a really good up move on the Bitcoin chart, correct? So this is basically our order block candle. If I draw it like that, you can see the market respected, the market pumped, respected this order block, pumped, and then went higher. So this is how basically you are supposed to use the order block concept for your own good, and this concept works really well, trust me. And like I said, I was showing you where I have placed my stop loss, correct? So over here in this particular trade, like I was saying, I went short on Bitcoin at this particular level. I went short over here. So usually where the stop losses would be for the normal technical bookworms, from here to here to here, or somewhere even here. But where have I placed my stop loss? So my stop loss is above this particular order block. So over here we had a really big fall, correct? And this is our order block candle. My stop loss is above this particular level, above this particular order block, because if this order block gets invalidated, it will make sure that all the selling pressure has been absorbed, and I am absolutely wrong about this particular trade. That is where I'm going to accept my mistake. So that is why my stop loss is over there. So especially into the crypto markets, you need to be very wider with your stop loss. And there's one very important concept that I'm going to cover in the last module of the course, that is shifting bias and knowing when to go into which direction of the markets. So make sure you take as many notes as possible and pay attention to this particular course. So yeah, like I said, my stop loss is over here. Why? Because there over here is an order block. So what usually happened? What happened over here? The market went lower, showed some profit, then it hunted all the stop losses of the people that was sitting over here, and then took resistance from the order block, came down, and then finally going lower. And even if the market comes higher once again, there is a very high chance that it will face some resistance in this particular order block. And even if it does not, it might break up and hit my stop loss. But over here, I am very ahead of the 99% of the crowd, because they are going to place the stop losses as per the technical analysis, and the big players very well know where the stop losses is, and they will definitely hunt out for the stop losses. So now this is the order block concept. Now there is one more concept that you should be knowing about, and that is called as imbalance. Now what is an imbalance? Let's try to understand. So an imbalance is basically a very huge candle where what happens is a very violent momentum happens, and sometimes, like I said, the order block region will not always get retested. The order block region might not always get retested. The market might not always come back to the order block. So what should be our next reference if we are not considering the order block? So this is known as the imbalance. So how to consider an imbalance? So first of all, we need a candle that where a huge amount of momentum happened, a very huge candle happened. So over here in this particular chart, I can see that over here this is a very big candle. So over here I'm going to mark out an imbalance. So what's an imbalance? Let me just try to explain it to you. So an imbalance is nothing but an imbalance in the market, imbalance in the buying and selling. And over here there was a huge imbalance on the upside. So what I'm going to do is I'm going to draw an imbalance over here. So remember, over here what we are going to consider is only the body of the candle. We are not going to consider the wicks of the candle over here. So I'm going to start off from here, and then over here in the second candle, you see the wick was over here, correct? So this is the area where my imbalance happened. This is my imbalance area. Now if you see, I selected from here and ended over here, because over here the wick is here. Why did I select it only this? Because in this area, this is the area where only buying has happened. Only and only buying has happened. We cannot see any selling over here because there was an imbalance in the market. So you have to consider only the second candle, obviously, or even the first candle. Even if you are just checking out for the chart, you can do this something like this as well. But over here, since I can see that second candle wick has happened over here, I'm going to consider only this particular region as an imbalance. Now how does an imbalance play an important role in our chart? So the 50% level, the half level of an imbalance, acts as a very good support or resistance. Why? Because the people in the market, when the market does a very violent move, obviously if the market pumped so much, obviously the people that wanted to buy over here or here, they are not going to buy here. The people that wanted to buy here or here, they are not going to buy over here because the market has already pumped. So what they do is they wait for the market to go back to the median. They wait for the market to at least do a 50% retracement or come back into the buying zone. So obviously the market went lower. Exactly in the middle of the imbalance, it took support and then went higher. So this is how an imbalance works. The 50% of an imbalance acts as a very, very good support or resistance. So what are we going to consider? We are going to consider only the wicks, only the body of the candle. So let me just try and give you another example on the higher time frame. So if I consider this particular candle, right, this huge candle, now what we are going to do, we are going to consider only and only the candle that, or only the wick part of the candle, correct? So this is our imbalance in the market, and you can see this is the area where only and only selling has happened. What happened next? The market came higher, exactly from the imbalance level, came down, went higher, from the imbalance level it went down yet again. So this is the imbalance concept. This is how we look for imbalances. Now imbalance is not a very good place to take trades, but definitely it is a concept that you should be knowing about for taking trades, or especially verifying your trades, or just looking at the chart. Now this is something that is there on your chart, but you are not able to see it unless and until you know about the concept. So this is something that you should definitely know, but I wouldn't suggest that you take trades on this particular concept. Personally, I prefer order blocks more over imbalances, because imbalances happen very, very rarely, but when they do, yes, they definitely work. But order blocks happen frequently. Obviously orders are always going to come into the market. Order blocks happen frequently, and order blocks work even better than imbalances. But imbalance is definitely a concept that you should be aware of and you should be knowing. For example, even if we go on the weekly time frame or on the daily time frame, let's try to find out an imbalance and see how the market reacted to that. We are going to find out. Okay, so over here we have a huge green candle. Over here Bitcoin pumped almost 20%. So let's try to draw an imbalance. So this is our imbalance zone, correct? The market went higher, came lower into the imbalance zone. This is a particular zone that was supposed to act as a very good support, even though the market did not dip that well over here, but it took some support in the imbalance level and then it went higher. So this is something that is going to be helpful to you when the market is on a bull run, or in a bear market when the market is dumping or pumping very violently. The imbalance concept is going to help you out very, very well, while the order block concept is going to help you out almost all the times in all phases of the markets. So this was the smart money concept. This is how the big players manipulate or try to hunt out the stop losses of the people. So in this session we talked about very, very important things such as liquidity hunting. We talked about who are the people that are technical bookworms, and why you should not be those people, that crowd of the people, especially in the crypto market, because in the crypto markets things are very, very advanced and a lot more difficult than any other financial market. But if you know all these concepts, things are going to get very, very simple for you. So we talked about liquidity pool hunting, we talked about technical bookworms, we talked about order blocks, we talked about imbalances, and these were the smart money concepts that you need to know if you are trading in the crypto markets. So thank you so much guys. I'll see you in the next module.